Hello everyone. So today I'll tell you about Ironfly, or it's known as iron butterfly as well. So it has been nicknamed as Ironfly. So today we'll see like how Ironfly is implemented, what is exactly an Ironfly is, what strategies are done to implement an Ironfly, and basically in what market conditions we should go ahead and do the Ironfly. So let's start with our video. So first, I'll give you a brief introduction about what is Ironfly. So let me move to next slide. Okay, so Ironfly is we can say it's more of a strategy which is a credit spread, and it involves a combination of four options. So where and it involves like four options. What I mean is that where you sell a ATM straddle. So you can see here I have mentioned you sell a ATM straddle and buy a OTM hedge. So what does an ATM straddle means? ATM straddle means, suppose I take an example of Bank Nifty. Bank Nifty is currently trading at 36,700 is the spot for Bank Nifty right now. So you will have to sell a straddle, ATM straddle, at the money straddle for 36,700. So you will sell one put option of 36,700 and one call option of 36,700, and you are going to buy a OTM hedge, that is out of the money hedge. So on put side we'll buy a hedge, and on call side we'll buy another hedge. So that I'll show you how the graph is plotted and everything. But first you understand what a basic Ironfly is. And then it involves a combination of four different contract options. So what does four different contract options means? It means what I mentioned just now: selling one put option, selling one call option, and then going to buying one put options and buying one call options. So that is the involvement of four different contract options. So that's why it is also called as, it's a credit spread strategy that basically involves these four options, and it limits your risk and as well as your potential profit as well, because your risk is limited, your profit is also limited. So here, that's what I have mentioned, it makes a bull call spread and a bear put spread. Bull call spread because you buy a call option, you sell a put option, and bear put spread is because you buy a put option, so if your market goes down you are benefited when buying a put option, and then you sell a call option, so your buy when your market falls, your call sell option will also protect you. So this is what is a generic definition of an Ironfly, or we can say iron butterfly. So let's move to the next one. So this is, I have tried to explain you a payoff graph, how it looks like. Its body looks like a butterfly, so that's why it's named as a iron butterfly as well. So here you can see I have marked as the max limit profit. So max limit profit is, as I mentioned, that if Bank Nifty is at 36,700, so if the Bank Nifty is expires at the same range where you have taken your Ironfly strategy, you are going to get the maximum profit. So this is your payoff graph where you're going to get a maximum profit, and then comes the upper break even and comes the lower break even. So when your price is higher than the strike price, so here you have taken 36,700 and the market moves to here to 36,700, 800. So your this point the graph comes down and there is a break even. So suppose for example your break even is at 36,700, so your break even is at 36,900, and here your break even is at 36,400. So these are your break even. So if the market goes beyond this break even, you will have a limited risk. So that's why it's known as a limited risk strategy. You're not going to lose your entire capital, but there will be a limited risk when it breaks your lower side, when it breaks your upper side. Now we'll move to the next one. When to execute the Ironfly. So the very big market players basically use this strategy during lower volatility, and when they believe that an underlying instrument will stay within a given range, throughout the options expiration date. So that's what the main fundamentals behind is, that the instrument should remain in the same price range. So if I'm taking the bank nifty Ironfly strategy at 36,700 as the spot, so the bank nifty should expire at the same range for the strategy to be maximum benefited. So that's the so, and it involves a lower volatility. What I basically sometimes prefers is like it can be done on a Tuesday or Wednesday for next week expiry. So today is, suppose the next expiry is 16th of September. So I would take the strategy on 9th of September, a previous week or before that, Wednesday or Tuesday, and I am going to square of this before the expiry, that before Thursday I'll square off my positions. And you can do it in a monthly or a quarterly expiry as well. So this is particularly safe because you know your risk. It's a limited risk strategy. It can be, what I prefer is that mostly if you take it after 1 or 2 p.m. of Wednesday for the next week expiry, it's totally fine. And again, that it comes into picture is the lower volatility. So these are the main things when you execute an Ironfly that you should consider. Then comes the benefits of an Ironfly. So the benefits are like, first, it's a limited risk strategy. So as I mentioned, as you can see from the graph, it's a limited risk. So if it breaks your break-even points, your risk is very limited. You're not going to lose your entire capital, and you know how much you are going to lose. So that's your limited risk strategy. So that, because the thing is that if the price rises above or below the break even points, the trader will pay more to buy back the short call or put than received initially. So that will result in a net loss. So that's a limited risk. Then comes, it protects you from unwanted events. So there, suppose in the night there is some black swan event, anything happens, so you are always protected because your risk is limited. You know, I am going to lose 2,000 rupees in this particular trade. So it's a limited risk. It will protect you from any kind of events. It's safety from market crash. Again, if the market crashes for XYZ reason, it's going to protect you. Margin benefit, I'll tell you in my next slide how you're going to get a margin benefit. Nowadays, as the SEBI has removed all the margin, you are not going to get any leverage. So it's a very good strategy where it protects, gives you a great margin benefits. I'll tell you how much margin benefit you will get in implementing this strategy. Then R ratio to R profit, what does it mean? Your risk is 1 hour and your profit is 2 hours. So if your risk is suppose 6,000 rupees, you're going to get a profit of 12,000 too. 1:2 is the risk reward ratio. So that's a very good risk reward ratio. Second is the for full time who are cannot sit on the screen full time. This is a very good strategy because this is going to give you a steady income without sitting full time on the screen. Then is the small capital comes into picture. So all the traders who doesn't have a very huge capital to play in option selling, so they can use this strategy with a small capital of like 5 lakhs as well. So going to the margin required for one lot of bank nifty. So before we go to this, I'll just tell you how we can plot the graph and what is the margin required for this. So let me show you that. Okay, yeah, so I am in the Opstra website. So let me show you how you can do particularly how we can plot, how you can get. Yeah, so here I'm in the Opstra website. So I'll just show you how you can basically do a Ironfly. So I'll from here I'll select instrument as Bank Nifty, and you can see the select expiry, maybe this monthly expiry. I will select the 30 September. So Opstra has a very good feature where you get this different strategies, and you can directly click on this strategy and it will make the payoff chart for you, graph for you. So, or otherwise you can do it manually as well by selecting a ATM straddle and buying OTM hedges. So we'll do it automatically using an Ironfly. So you can see it has taken 36,900 as per the current Bank Nifty futures. So it is selling one lot of P for 36,900, one lot of C for 36,900, and it has bought FAR OTM hedge of 35,800 and 38,000 basically. So now we'll add this short Ironfly, and we will just see how the payoff chart looks. So you can see the payoff chart looks exactly the same I have shown you in the PowerPoint. It's the body of a butterfly and the two wings this side, and you can see first we'll go to the range. What is the range it has been given? So you can see the range is break-even point. So the first break-even point at the lower side is 36,140, and on the higher side the break-even point is around 37,660. So once market or bank nifty moves beyond this point, maybe on the lower side or on the higher side, your loss starts. So your risk is only after this particular point. And as I mentioned, the risk reward ratio, so you can see the maximum you can lose is 12% of your capital, and the maximum you can gain is 27%, which is just double, more than double of your risk. So this is the risk reward ratio, and then comes the margin. So margin, you can see margin is around 69,000. This is for selling one lot of bank nifty put and call and buying one lot of bank nifty put and call option. So this is how it works. So let's see in the Zerodha calculator how it looks for this particular one. So let me so here I am in the Zerodha calculator. So here you can see, if I select Bank Nifty 30 September, and suppose if I sell a 36,900 call, what we have done there. So first let me reset it and let me add a Bank Nifty, and I'll show you how much margin benefit we get exactly using our Ironfly. So we select, and let me select, we have like 36,900 call. So I add this one. So see, for sale, oh sorry, it's for sale, for selling one lot of, just a second, and let me add again. Yeah, so this is the options. So if I sell 36,900 call and add, so you can see the margin required for selling one lot is 1,43,000. What does this mean? Total margin, this much amount should be in your demat account, in your trading account, for taking this lot of Bank Nifty. And when you take, so if I add, so it's 1,43,000. Now if I add the put option, how much margin reduction do we get? So it comes out to be 1,66,000, out of which you receive 30,000 as a premium amount. So it comes out to be around 1,36,000. That's the margin you are getting. You have to, now I apply an Ironfly. So I buy a 35,800 put option. Here I add it, and I add a 38,000 call option. I buy it and I add it. So you can see the margin benefit is 61,000. The total margin required for taking this particular trade is only 61,000, out of which you have already got a premium of 20,000, around 20,000. So only from your pocket it's going only 41,000. So this is the benefit, the biggest benefit of Ironfly is, so it's a limited risk strategy. The profit will also be limited, but if you are really wanted a strategy where you know your risk, you know how you can come out when you have to come out of your particular trade, it's a very good strategy. So this is what I have to tell in this video. So maybe in the next video I'll tell more about Ironfly, how the adjustments can be done, and more advanced topics on Ironfly. So for now, this is what I have to show you. So thank you everyone, and please do visit my next videos. Thank you.